Hey, it's Wayne Wagner from Visionary Wealth Management. I wanted to take just a minute to speak with you about one item that's on everybody's mind these days, and that's inflation. I mean, we've gotten some really outlandish numbers, 6 and 7% headline numbers for inflation, and gosh, if you've been to the grocery store, it feels even worse than that. So let's talk about what that means long term, because if you're near or at or in retirement, and some of our clients have come to us and said, Wayne, we're only factoring in 3% inflation. What are we going to do? I mean, we've got 7% inflation. It's a valid question to ask. The short answer is what we need to do is we need to worry about having the portfolio outpace inflation by at least 3%. And what do I mean by that? It's because usually when we're running forecasts with like somewhere between a 5.5% and a 6.5% rate of return expectation, and then a 3% inflation. So we're usually talking about inflation plus somewhere between 2.5% and 3.5% returns is what we need to get out of the portfolio. And so if we got a 6 or 7% headline inflation number, what we really need to do is look at the overall portfolio performance and more granularly look at your equities allocation. Because likely what we're going to see is that the equities allocation did way higher than that 6 or 7% number, could have been 2 or 3 times that, and then the overall portfolio likely still beat inflation by more than that 3%, that 2.5 to 3.5% margin that we need. So please don't worry about headline inflation. The other thing I'll point out is that we factor in 3% inflation over long periods of time, and if you think about inflation over the course of the last 10 years, there hasn't been a whole lot. And so just because we're getting some kind of catching up on the inflation numbers from over the course of the last decade shouldn't be cause for panic at this stage. Now, we do think that we're going to continue to see some kind of scary, some intimidating inflation numbers, and here's where you do have exposure in your portfolio, and that's going to be in your bond exposure, right? So if we own bond index funds or bond index portfolios, if your 401k, if you have money in a stable value fund that usually is invested in 10-year T-bills, things like that, or if you're using just kind of a bond index strategy or an investment grade bond strategy, that's where you're going to have direct exposure both to inflation and the risk of loss of capital in a rising interest rate environment. Now, if you've talked with us for any length of time about what's actually in your portfolio with us, you'll know that we have almost no exposure to those kind of bond index strategies because we've thought for some time that with interest rates at all-time lows, that there were really 2 things for interest rates to do. Either tread sideways, in which we're not going to make hardly anything in those kinds of bonds, or interest rates to trend up, in which case those bond index and investment grade bond strategies are really going to lose money. And so we thought if 2 out of the 3 possible outcomes, really statistically most likely outcomes with interest rates, were going to be debilitating or dangerous for our clients, we've kind of steered away from those areas of the bond market. So we've used things like fixed index annuities, high yield municipal bond funds, floating rate bond funds, things like that, that are don't have as much direct exposure to the risk of interest rates jumping up or inflation factors. So those are some of the strategies that we've implemented on our side to try to protect you in advance. Here at Visionary Wealth Management, we're always here with perspective for the decisions ahead. If this has been helpful, please feel free to give us a like or pass it on. And if you have any questions about your portfolio or areas that we can help with, please don't hesitate to ask. You're never an inconvenience to our day. You are the reason we get to go to work in the morning. Thanks so much. Have a great week.